Well, I can't seem to get away from this real estate bubble bursting. As Cliff High said, WebArt report, it will start with high-end real estate and then go to all regular real estate after that. It's not going to be another 2008 thing where it crashed, we had the bailout, it actually gained back again, and then never got back to where it was, of course, but now it's sitting kind of still. It's on pause, if you will. I talked about this just the other day with the Martin Armstrong chart that shows 2015.75 out to 2032.95, I believe, is a downward trend for real estate. I'm going to show you that chart, and I also was able to find online moments ago 1900, the year 1900 to 2010, the housing trend prices. Because I was curious if his little chart with these different little cycles and showing in there would show the same thing as this chart from 1900 to 2010. Now, granted, I can't go to 2015. This chart that I found only goes to 2010. However, we already know with the last 5 and 6 years what happened. So first, I want to read this article from Zero Hedge. UK fund managers start dumping properties. Admit real estate needed repricing. The uncomfortable moment of truth has arrived for property funds in the UK and their investors, of course. Following the initial tumble of the post-Brexit dominoes, 8 major funds so far either gating redemptions or forcing massive haircuts onto investors who want out. Contagion concerns even woke up Britain's regulators and central bank as fears of Bear Stearns-esque forced liquidations spread. And now, as the Financial Times reports, that is what has just started. With every UK property fund knowing every other UK property fund needs to sell assets, as in real physical illiquid property, to meet cash calls in their unreal faux liquidity funds, the game theoretical first mover advantage has begun with Henderson Global Investors, which has begun offloading prime assets, again, high-end prime, to provide liquidity to investors. The major fund plans to sell 440 Strand, which is the headquarters of the private bank Coutts, by the end of 2016. The property, bought for 175 million euros in 2014, was valued at 220 million before the Brexit vote and will be formally brought onto the market in the autumn by the suspended Henderson UK Property Fund, according to 2 people briefed on the plans. The sale of 440 Strand is one of a number of disposals expected to follow the suspensions of 7 property funds last week after investors rushed for the exit following the UK's vote to leave the EU. Henderson, which manages the fund through TH Real Estate, its joint venture with the U.S. retirement provider, TIAA-CREF, declined to comment. Joint venture with the U.S. retirement provider. And if real estate market goes south, what happens to those retirements that you handle? Because I'm sure you're invested in this real estate. Lindsey Williams, I will channel Lindsey Williams for you right now. Here he is. Here he goes. Lindsey Williams. If it is written on a piece of paper, it is not going to be worth the paper it is written on when they collapse the markets. Continuing on. Funds holding more than 15 billion euros of investors' money are preventing redemptions, including the UK's largest property fund, M&G's $4.3 billion property portfolio, and funds from Stanford Life, Henderson, Aviva, Columbia, Threadneedle, and Canada Life. Aberdeen Asset Management, which suspended its fund for a shorter period than the others, until July 13th, has begun marketing properties, including an office building at 10 Hammersmith Grove, the UK headquarters of Fox International, a division of 21st Century Fox. Early bids on the buildings Aberdeen is marketing indicates yields 50 basis points higher than before the Brexit vote, according to people briefed on these sales. This indicates there will be discounts. But, Zero Hedge, we note the Financial Times carefully scripted, do not panic, edit here, not the steep drops in price seen during the 2008 financial crisis. So yeah, we're discounts, yeah, but not like 2008, not like 2008, don't worry, it's cool. Really, because I got a chart I want to show you here in a second. But given the following chart as example of the liquidity gap between fund level liquidations and the exuberant UK real estate market, things could get ugly very quickly. I'm not going to show you that because you don't need to see this chart. You wait till you see my chart. Perhaps even more troubling is the reality that you sell what you can, not what you want to. Property funds are expected to focus initially on disposing of prime, again, higher end, assets, which will be easier to sell in uncertain markets, agents said. Investors are more worried about properties and sectors thought to be vulnerable to Brexit, such as London offices, which suggests the lower quality assets could be severely impaired, just as Richard Duvall, head of cross-border capital markets at the Property Advisors Colliers, admitted by saying, quote, Brexit has caused short-term panic and stalling to most of the UK market, but UK real estate needed repricing. The world looked at the UK as too expensive 9 months ago, end quote. How about too expensive for the last 40 or 50 years? According to this chart I'm going to show you. And with managers forced to liquidate some of their best holdings to raise cash, the potential for fire sale prices is very real. Once again, the chart above suggests the mark-to-market impact on real estate, real UK property alone could be significant. And that is why, as we previously noted, the Bank of England has been mulling a bailout. The Bank of England strawman here is likely the first step down the road of a full-blown bailout. A slush fund to promise to buy UK property from the funds with the hope that once they even mention it, investors will stop their selling and pile back in. Of course, we have seen and heard all this before, about 9 years ago, when any number of government backstops, bailouts, partnerships, and direct buying did nothing to stop the contagious collateral chain collapsing following the gating and liquidation of two Bear Stearns funds. We will never learn, and this time is no different, for as one major fund manager warned, quote, this throws up all sorts of questions about the sustainability of daily traded, open-ended property funds that are giving investors access to an illiquid asset, end quote. But all the time, investors believe a central bank has their back. This is not a problem. Until it is the problem, and the walls come thundering down. It would seem monitoring the price discussions of 440 Strand is a good indicator of a crisis as any, and perhaps the least manipulated, at least for now. Now, I want to show you, by ending this video, this here chart. We have, on the top left, I added this other chart to it, U.S. Housing Price Index 6, 1900. The center of that chart, slightly to the left, where it actually starts to finally start going up, is the year 1950. So we have 1950, 1960, 70, 80, 90, 2000, and 2010. Now look underneath here, 1955 to approximately, this one goes to 2012. And you'll notice the general trend for housing from 1955 to the year 2007 is up. Right? Just like this little chart above it. And then we have 2008, 9, and 10, 11, 12, prices go way down, which is exactly what is reflected in this housing price index chart above on the left. We have the same years roughly, 2007, 8, 9, and 10, right here, peak over here, down over here. But again, this chart doesn't go to 2015, because if it did, you would actually see this rebound a little bit. The top left chart, you'd see it rebound a little bit, only to start its massive and epic decline over the next 16 years, according to Martin Armstrong's real estate cycles. It's in his economic cycle whatever the hell he calls it, the ECM or whatever. The guy has so much data. I've already discussed this. He has so much data going back since before Christ. Empires that have fallen, everything you can think of. This guy's been compiling data like it's out, like there's nothing else like it I can even think of. And this chart is the real estate chart that shows 2015.75, which is technically October 1st, 2015 to 2032.95, or you might as well round off 2033, which also means the best deal of anyone's life is going to be in the year 2033. However, having said that, there's not a chance in hell, honestly, that I would sit here in 2016 and say, I think I'll just go ahead and continue renting for the next 16 years. Don't own anything. Just keep paying rent. Essentially throwing the money away to get a really, really sweetheart deal in 2033. A whole lot can go wrong in that time period with the world. And from the looks of things currently, boy, oh boy, we got some problems coming up here and actually happening as we speak. So I don't think I want to risk that. Again, my plan is to watch silver rise, and when it hits the magic number that I feel comfortable with based off of how everything else is going in the world, and based off of what is real estate prices, the real estate market doing right now, as my silver is looking great, will make me determine how quickly I'm going to go ahead and buy a house. And as I said, wouldn't it be fantastic to say, silver went up and I was able to sell it and bought a house free and clear. No mortgage, no BS, no nonsense, no interest rates, none of that crap. Bought a freaking house with some silver because I've been screaming about buying it all these years, and it actually finally paid off. It can't go to zero. Your property fund management company, your investment can, and throughout history does go to zero, or so close to it. It's, oh my God, I had $100,000 in my retirement. Now I've got $5,000 or $10,000. 90% haircut, 95% haircut. Have a nice day. You might as well say that's zero. I mean, if you had $100K and you now got 5 or 10K, you're pretty much screwed. But if you've been buying silver all these years, and I said this before, can you imagine being awakened to the level we have been over the last several years and saying, man, oh man, why couldn't I know this stuff back in 2003, 2004, 2005 even? Because I was just beginning to look at stuff in 2005 and not this financial stuff. I didn't start there. $3, $4, $5 an ounce for silver. Can you freaking imagine? What was the premium on a silver eagle then? Today it's $2.20. They're like trying to have fire sales right now for silver eagle. It's a little over $2 a coin over spot, for a silver eagle. I mean, what was it when silver was $3? 10 or 20 cents over spot. It's $3 today. It's $3.20 for silver eagle. Could you imagine loading the boat back then? And I think, and I'm so excited about the time, 2009 or whatever it was, they smashed silver down to like 9 something actually. And then, it was so brief you really couldn't even count it, but $10 essentially. And I bought some silver eagles then. I was so ecstatic. We paid $2 over spot, so I got it for $12. Man, was I excited about that. Man, that felt great. But man, could you imagine getting it at $4 and $5? How much better that would feel? Because I bought at $10, $13, $17, $18, $20, $25, $33, all over the damn place. $42, I think. I bought 25 ounces at $42. I was buying when it was going up. I'm buying when it goes down. Again, I'm looking at this as when this shit finally goes down, you're not getting a second chance. You're not getting a do-over. You better hope that you did the right thing and invested or tried to deal with your financial situation the right way in advance of this crap happening. Because once it happens, now it becomes history. You can't go back and, let me go, get in the DeLorean and go 88 miles per hour and go back into the future and buy some more. Not happening. Not freaking happening. This is that chance. This is why you must do these things now. You will not get a second chance. You will not get a do-over. Again, this chart, 16 years we've got of real estate prices starting to go down. That doesn't mean they're going to collapse all at once this year and then collapse even more. I mean, again, we've got a downward trend. Now, if you look, though, let's look at this for a minute. 1955, the year. 1955, 65, 75, 85, 95, 2005. That's 50 years. 50 years. Technically 50, well, from 1950. Yeah, 50 years, okay? And it took that long for that chart to do what it's doing on the upside. That's what housing did. We're only talking 16 years, or roughly 1/3 of the time it took to go up. It's going to come down, which suggests pretty strong decline in the real estate market year after year after year, if we're to believe this. And I see why we have no reason not to believe it, because the man shows these 309-year cycles, these thousands of years, all the stuff. It's like a sine wave in the same pattern, just same wavelength all the way across. You'd almost be a fool to say, I don't know, this time will be different. I will say in his models, it shows that the private debt goes like this and then goes up significantly. Then after that, we have the public debt do the same exact thing and then go up significantly at the very end when a big reset occurs at the end. Many times, superpowers becoming ancient history and going away, like the Roman Empire, the Byzantine Empire, etc. So if that chart means anything, we literally have right now, 2016 to approximately 2032, 2033, to get this massive, unbelievable amount of debt built up, which to me says, well, then how do we have a new world currency in 2018 and all that stuff? That's what I would expect in 2032 by his charts. His charts are suggesting that the most unbelievable debt bubble that we thought is right now is child's play compared to what his chart shows coming over the next few years. But if he has that kind of history and that kind of documentation in his database, it's something to pay attention to. It really is. Take care.